Yeah, let's not go blowing up your Forex account, eh? Let's go. Well, that was a little bit dramatic, but necessary. As you may have gathered, we're all about risk today, and there's so much to cover it's been really hard to know where to start, and that's because managing risk is the number one priority with any form of trading and investing. If you can't manage your downside, then what's the point? You're essentially gambling, and as CFD traders or Forex traders, we are managers of risk. It is priority number one. If you can manage your risk and survive for the long term, then you're in with a shot at making it. Otherwise, you're gonskis. So I'm going to be covering as much as I can about the risks of Forex trading in this video, and we'll be going very deep, so take notes. And depending on how long this takes, this may be getting split into two parts. I suspect it already might be, but let's see. And if you are liking the content so far, don't forget to drop a like and subscribe, and jump into the Discord channel if you want to come and say g'day to the crew. The link is in the description below. A reminder for anyone else as well that might be brand new to the channel, I'm transparent with my own results and I've got them on display through my FX book. I've got the link provided below as well. Feel free to add it to your watch list if you want to track it. Alright, we need to get straight into this one because I was kidding myself earlier thinking this can be done in one episode. This will be a 101 ways to kill your account type of video, split over two parts. I'll get us going on some of the more obvious risks in this video before discussing some more sort of left of center juicy stuff in part two. Bang! Agenda. Don't know what the hell this soundtrack is, but we're going to try and rock it. Ways to blow up your account number one, a lack of stop loss. There's often debate in the CFD world over whether using a stop loss is beneficial or not, or whether it's just a hindrance. And the main argument for not having one is being, well, if you experience pretty much a huge gap or market move with slippage, then you're either not going to get your order filled at all, or at least not where you wanted your order to be closed out at. And part two of this argument that I've heard is that stop losses get in the way of your market edge and they just kick you out of your trades where your edge is playing out. The alternative being to instead just to let your trade run type of thing with a time-based closed or some hedging and small trading sizes. I really don't like this in general because assuming your market edge isn't some underlying shitty gambling technique, you need to expect to have these losses as a part of your trading. It'll still make money in the long term. Just take that hit and move on, get used to losses. And hedging in and out of positions can really become an intensive, time-consuming process, even with automation. No one wants to do that constantly. Keep things simple, help protect your downside, use the stop loss. And when there is some crazy market event, just that one time it might get you out right where you need to. You never know, it's worth the risk. And that leads to risk per trade. I'll keep the comments on this one general for now. We'll get a little bit more involved with the specifics of risk allocation down the track. However, if you are using a stop loss, it is really easy to calculate a defined risk per trade as a percentage. And what's the ideal amount to risk? Is it 5%? 2%? I've seen a lot of methods out there that say 2 to 1%. But overall, it really depends on your risk appetite. I trade my personal funds with a bit of spice, but not too much extra than what I'd trade for others at an institutional level. And that institutional level risk lands at about 0.25 to 0.4% of your account balance at risk per trade. If you run this risk across 7 to 10 uncorrelated systems, as a ballpark, your max drawdown is unlikely to go any higher than, say, 15%. Running lower risk means you'll have a smoother equity curve over a shorter time span. Run higher risk and your equity curve's going to start looking like a busted up elevator until you trade your system out over the long term. And then of course there is market exposure. You can have multiple positions that are open at once, and this can increase your overall risk exposure to a specific market asset. You can also increase your exposure from being tied up with direct or indirect market correlation between assets that you are trading, or you might just accidentally get caught up in some market-wide move because Elon tweeted something random again. Overall though, try and limit your market exposure so that no more of 0.8% of your account balance can be chunked down at any one time from a move in the markets. Cool, what are we at? Next one, leverage.
I believe I can touch the sky.
So trading CFDs will almost always involve the use of leverage. And for traders that are newish, this just means that you can use smaller amounts of money to open larger position sizes. And while trading with leverage does magnify your wins or losses in general, for us, we control this by allocating a percent of our account balance to risk per trade with our stop loss. It is because of leverage that we can trade instruments that have large contract values. And that's pretty much all of them in general. So let's take Euro USD for example. The contract value is 100,000 US dollars per lot on a USD account. Otherwise, you have to do conversions into your local currency. Without leverage, you'd have to pay the full amount of your contract size. So let's say you entered 0.1 lots, you'd have to put down 10,000 USD of cash on the table to be able to open that position. If you were to have high leverage, let's say 30 to 1, you'd only need to put down, what's that, like $333 to be able to open that position. This money that you have to put on the table to open a position is called margin. If you can control your overall risk using percent-based risk allocations per trade, then high leverage is simply allowing you the opportunity to open additional positions by conserving the amount of margin that you have that's available to use. With the style of low-risk trading that we will be using, we generally don't have to worry about limitations with leverage and margin, and that's because our trading's so low risk anyway. If though, however, you are in a regulated country that has restrictions on crypto CFDs, you might run into issues. As an example, here in Australia, the retail leverage for trading cryptocurrencies is set to 2 to 1 or 50%. So let's say a one lot contract of Bitcoin against the Aussie dollar has a value of 150,000. If you were to try and open a position of 0.07 lots on Bitcoin against the Aussie, you would need just over $5,000 of margin to open up the position on 2 to 1 leverage. So you really need to make sure you know what your margin capacity is for your trading account if you are looking to add in cryptos. And this will depend on your account balance, the leverage that you are allowed in your jurisdiction, and your rough contract sizes that you will be trading with. Outside of our low risk style of trading, if you are a trader that in general trades with crazy leverage so that you can enter irresponsible lot sizes, then you are cruising for a bruising. Particularly if you aren't using stops either. Your losses will be magnified if the position turns against you. Just don't do it. It's not worth the risk and you're gambling. Take the safe approach and spend the time to learn how to trade responsibly. Entering high position sizes also increases your chance of slippage during your trade execution, and this will immediately put the odds against you. If you want to check this out, Trader Nick has some reaction videos tucked away of people getting majorly slipped by entering crazy lot sizes on some small accounts. Go check them out. If none of the above made any sense at all, then do spend some time reading up on any of the terminology used. So this channel is going to be a bit more advanced, and I don't know, maybe I'll do a bit more of a Forex 101 playlist down the track, but for now we've just got to keep rolling. Second last, trading a third-party expert advisor. This is such a bad idea. Such a very, very bad idea. Even if you have backtested a system accurately over a lot of data, relying on a single strategy to make you profits is not good for a variety of reasons that we've already gone over, particularly in the Holy Grail video. If you haven't seen it, go and check it out. I always see people that have bought or are looking for free EAs to run because they think expert advisors are fancy and they're the shiz. And they probably don't even have an understanding of what the system's doing for them. Just don't do it. This is a very, very lazy way to try and beat the market, and that laziness will bite these people when their accounts start blowing up. It's a rookie mistake for so many reasons, including not knowing how to set up an EA properly, not knowing how to allocate risk for it, not knowing how to properly backtest. Some people probably don't even backtest these things. It does my head in. Man, the list just goes on. But save yourself the pain, learn how to trade properly, because in general, you can't guarantee the robustness of a system. We'll use Northeast Way as an example, which also leads into the last topic, trading an absolute strategy. So there are a lot of strategies out there that are responsible for blowing up accounts all over the place, and these are mostly related to grid or martingale gambling methods. I'll do a video later on how to identify these and how they generally work, but go look it up in the meantime if you want. Long story short, as an example, the Northeast Way was a martingale system that people willingly bought and they actually ran live. And there was a managed fund that ran the system that was being tracked on my FX book a couple of years ago, and it had at least 15 million US in there. That tracker has since been deleted. But the strategy at that point in time had lasted for 2 years, which I'll give it credit for because usually these things don't make it past a year before blowing up. But people unfortunately got sucked in by the strategy's extremely high win rate and unrealistic equity curve. And by the way, don't ever get baited by people sprigging high win rate systems. Extremely high win rates aren't usually a good thing. But statistics and time eventually caught up with Northeast Way, and of course, like every other martingale strategy out there, it eventually blew up and people lost a lot of money. Unfortunately, most people trading this system probably wouldn't have even known that they were gambling against the clock. So be aware of these systems, don't trade them, it's irresponsible and it won't get you anywhere long term. Alright, we are done here for now. Hope you learnt something. This has been part 1 of our talk on risks in Forex. Part 2 has another 8 or so things to go through, which are going to be a bit more obscure, but still very important, so stay tuned. Until then, laters.